Hello, everyone. Welcome to another session of financial accounting in the Wisest King Academy. Today, we are going to be working on cash flow statement. This is a very important topic. I am Don Solomon, and it's always a pleasure reaching out to you with a new video. Please, if you're new, do not forget to subscribe and hit the notification bell so that every time when I post a new video, you are going to be alerted individually. And also, please like this video if you find it useful so that YouTube can recommend it to others. So, today we'll be working on the cash flow statement. The cash flow statement is treated either in International Accounting Standard 7 or in Financial Reporting Standard 1. Now, today we are going to see how to prepare the cash flow statement under the International Accounting Standard 7. Now, what is a cash flow statement? A cash flow statement is actually one of the financial statements prepared. The content of the financial statement of a company is made up of the income statement, the statement of financial position, the statement of changes in equity, the cash flow statement, and the notes to the account. So these are the five elements that constitute the financial statements of a company. So the cash flow statement is actually one of the major statements. Now, why do we prepare a cash flow statement? Or let me start first of all. What is a cash flow statement? A cash flow statement is a financial statement that shows the movement of money into and out of the business. The movement of money into and out of the business as at the end of a particular period. The cash flow statement is actually prepared for this reason. Why do we prepare a cash flow statement? The main reason why the cash flow statement is prepared is because of the difference that exists between liquidity and profitability. I take an example. How is it possible that we make a profit yet we have an overdraft in the bank? Or how is it that we made a loss and yet we have cash in hand and a bank? Difference between liquidity and profitability. That's what brings up the preparation of the cash flow statement. Now, the cash flow statement is prepared using the income statement and the statement of financial position. Statement of financial position. The cash flow statement is prepared using the income statement, the statement of comprehensive income, and the statement of financial position. Very, 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 very important. Okay. The International Accounting Standard 7 requires that a cash flow statement should be prepared using three standard headings. And what are these three standard headings? We have the operating activities. We have the investing activities, and we have the financing activities. Now, remember I said the cash flow statement is prepared using the income statement and the statement of financial position. So we are going to partition these three activities. These three headings using these two financial statements are both. Okay, let's recall that the statement of financial position shows the assets, which are actually the non-current assets and the current assets. It also shows the obligations, that's the liabilities, which are actually current liability and non-current liability. And it actually shows what? The equity and the reserves. So we are going to partition all of this with respect to the three activities. Now, there are two methods in presenting a cash flow, or two formats. There's a direct method and the indirect method. But this method is actually determined based on the operating activities. Now, the operating activities is aimed at determining the net cash flow from operating activity. And this net cash flow from operating activity can be done in two ways, either directly or indirectly. So, in order for this video not to be long, I'm going to first of all skip the operating activities, right? And I'll explain the investing activities and the financing activities. But notwithstanding, let me give a general explanation. Now, with the operating activities is actually short term. Now, the operating activities is prepared with information from the income statement and working capital. Working capital talk about current asset and current liability, excluding cash in hand and cash at bank and bank overdraft, if any. The investing activities is prepared using the non-current assets, that it shows movement in the non-current assets. Now, when we talk about movement in current assets, did we purchase non-current assets within the year? Did we sell? Did we dispose non-current assets within the year? Now, such movements are shown under the investing activities. So only the movements in non-current assets. Now when we talk about the the financing activity shows the non-current liability, that's long-term liability. It shows equity, non-current liabilities and equity. Non-current liabilities, maybe since it's a company, debenture loans or bank loans. Now, if you obtain a bank loan during the period, money came in. But if we redeem part of debentures or we redeem part of the loan, you see money went up. That's a movement in non-current liability. And now, in equity, maybe there was issue of shares. If there was an issue of share, you see an increase in capital. And take note, such issues may be either in cash or in kind. Maybe either in cash or in kind. So we are going to see that. And now also under equity, we have share premium. We also have share premium. And we also have the dividends paid. So these are actually the three activities. You can see that the operating activity is prepared using information from the income statement and the working capital, that's current asset and current liability. The investing activity shows movement in non-current assets. Meanwhile, the financing activity shows movement in non-current liabilities and the equity. And please, the movement we are talking about here is the financial movement, cash movement. Okay, so like I said, my next video, I'm going to explain the two methods of calculating the net cash flow from the operating activity. For now, I'm going to explain the investing activity and the financing activity. And before I get into that, preparing a cash flow statement, there is what we call cash and cash equivalents. Now, when we talk about cash and cash equivalent refers to cash in hand and at bank and other short-term, highly liquid assets that are easily convertible into cash, right? Without a significant risk of change in value. Examples here, we'll talk about promissory notes, bills of exchange, treasury bills. Those are cash equivalents. So, the sum of the operating activity, that's the net cash flow from the operating activity, the net cash flow from the investing activity, and the net cash flow from the financing activity, gives what we call the net cash and cash equivalents. This net cash and cash equivalent, number one, it shows the difference that exists between the opening liquidity and the closing liquidity. And by so doing, if you take the liquidity at the beginning of the period, when I talk about the liquidity at the beginning of the period, I'm talking about the cash and cash equivalent at the beginning of the period. That's the cash in hand, cash at bank, treasury bills, promissory note at the beginning of the period. If you sum all of them, if you add it to the net cash and cash equivalent, is going to give you the cash and cash equivalent at close. That is the sum of the cash in hand, cash at bank, promissory notes, bills of exchange, treasury bills. And please note, bank overdraft is a cash, not even an equivalent, a cash. Simply that is a negative cash. So, in brief, that is how you do to know that your cash flow statement is balanced. Number one, either when the net cash and cash equivalent is the difference that exists between an opening cash and bank balance with the closing cash and bank balance, or if you add your opening cash and bank balance to your net cash and cash equivalent, it gives you your closing cash and bank balance. So, as I said, I am going to explain to you people the investing activities and the financing activities. Meanwhile, in the next video, because I don't want the video to be long, I'm going to explain the direct method and the indirect method of determining the net cash from operating activities. So I'm going to take number 2, investing activities. Investing activities actually shows the movement in non-current assets, meaning it is prepared with information from the non-current assets. That is, it shows the movement that took place in the non-current asset. For example, cash purchase of property, plant, and equipment, disposal, proceeds on disposal, or the consideration, cash consideration, please, because the consideration may also be in kind. The cash consideration on the disposal of non-current assets. We can also see purchase of goodwill, purchase of investments, and also sales of investments. So those are actually the movements that take place in the investing activity. So we take purchase of property, plant, and equipment, or NCE, right? We are going to have a negative. Right? If we have proceeds on disposal, proceeds on disposal of NCA or property, plant, and equipment, that is positive, right? Purchase of investment, purchase of investment, still negative. Now let's say we have invested and they pay us dividends. That's going to be recorded under the investing activity. So you will have dividends received. That's going to be positive. So if you add all of that, you have the net cash flow from investing activities. Now this value may be positive or negative. Now there is dividends received if the company has purchased shares in another company or the company has invested in another company. So you see, the company will receive dividend, the company will receive income. And by so doing, this will be shown under the investing activities. Now let's take the third one, financing activities. Now, the financing activities actually shows movement in the non-current liability and equity. And please remember, equity is actually made up of share capital, share premium, retained earnings, and reserves. Take note. Now, when we talk about reserves, there are two types of reserves. There are two types of reserve, although we are not going to look about reserves here. There are revenue reserve and capital reserve. For example, if a non-current asset is revalued, there is a capital reserve. And that capital reserve does not affect profit. But a revenue reserve simply means a revenue reserve, also called a profit reserve, is a is a reserve that is taken from profit. Maybe general reserve. Are we together? When we take a reserve from a profit for the period, right? That is actually a profit reserve. Now, take note, this is useful in the determination of the net profit before tax, because that is one calculation we are going to do. Okay, examples of financing activities. We have proceeds from issue of shares. Proceeds from issue of shares. Now positive, because when we sell shares, money comes in, right? Now we can have proceeds from share premium. Share premium, right? We have dividends paid. Now this is the dividends paid to the shareholders, right? And that's going to be negative. We have loan obtained or repaid. Loan repaid, so money is going out. Loan obtained means money came in. When we pay the loan, money is going out. The same thing with ventures. The same thing with bank loan. So let me just give you that estimate, right? So this will actually give us what? The net cash flow from financing activities, which may be positive or negative. Now let me analyze this. To prepare a cash flow statement, there you are given the income statement and the statement of financial position. And the statement of financial position is usually for two periods, the opening and the closing. Take note. The statement of financial position is usually for two periods. They cannot give you a statement of financial position for one period and ask you to prepare a cash flow statement. It is not that it's impossible. It is possible, right? It is possible. But it is going to be, it is possible. But since it shows movement, it means we are trying to reconcile starting from a starting point to an end point. That's why the statement of financial position is usually given for two periods, opening period and closing period. Very, very important. Now, let's look in a case where there is an increase in capital. When you pick up the statement of financial position, you look at your capital, you notice there is an increase. Now, the first thing you need to know is that the increase may not only be for cash or by cash. Observe things like the share premium and the reserve. There are situations where they can convert reserves to capital. They can convert share premium to capital. Then given bonus shares or rights issues, bonus issues or right issues to existing shareholders. Now, with bonus issues, they don't pay for the share. They are bonus shares. So they don't pay for it. So with such shares, their share premium or their reserve are converted to share capital. But with right issues, existing shareholders are given the privilege to subscribe for new shares. And now, right issues and bonus issues are always done on a pro rata base, based on the existing shareholding. And now, if it is a right issue, the shareholders will pay for the share. They may pay for the share at the nominal value, or they may pay for the share at a premium, as above the nominal value. So that is it. So when you pick up a question, please observe this increase in capital. Is it in cash? Observe the movement in share premium, the movement in retained earnings. Sorry, the reserves. If there's a decrease in those values, verify whether the same increase that took place, that occurred in capital, is the same decrease that took place in the share premium or in the reserve. If that be the case, it therefore means that it was a bonus issue and it was not for cash. But if there is an increase in capital and there is an increase in share premium, right, and you're told of bonus shares, of right shares, it therefore means that the increase in capital was a cash. Please take note. Now, when you look at your non-current liability, your bank loan or your debenture loan, if you see that there's an increase in the value, let's say at the beginning we have 10,000, at the end we have 12,000, it means we subscribed for more, we took more loan. But if there's a decrease in value, it means we redeemed part of the loan. And now, if we redeem, it means money went out, that's a negative cash flow. But if it increased, it means money came in, that's a positive cash flow. Very, very important. The dividends paid in the period. Take note with dividends. If you are given only the statement of financial position for 2 periods, now the dividends in the period, you can see it on the current liability. And now you should know this. The dividends that is paid in the present period is the dividends for the previous period. Because we assume that the capital spends time in the business, and at the end of the period, the shareholders are due their dividend. But there are cases where shareholders may have interim dividends. So in that case, they will give you proposed dividends, and they are going to give you dividends paid. So in a case where you have only the statement of financial position, you have dividend at start and dividend at end. The dividend at start is the dividend that is paid in the end period. And the dividend at end is the dividend that is proposed for that period. Okay, so we know that. The same thing, please permit me to come back to the investing activity. Take notes. Movement in non-current assets. Very, very important. If there is an increase in the value of non-current asset, the first thing it triggers is that maybe there's been a purchase. That's the first thing. But now, if you have a revaluation reserve, maybe the increase of the value of the non-current asset, maybe land, may be a revaluation. Take note. Take note, especially land. If you observe an increase in the value of land and the question does not have a revaluation reserve, it therefore means that the increase in land was in cash. But if you see a revaluation reserve, take note, the net increase in the revaluation reserve will be the net increase in the value of the land. If we have land increase on the debit side. So if you take that value on the debit side and you discover it's the same thing that increases in equity. That's a double entry. Debit land account and credit the equity. That's a revaluation reserve. That's actually telling you that what the value of land has increased. Land has been revalued. And so the double entry of that transaction is that revaluation reserve is credited. Proceeds of disposal. And let's also note that non-current assets may be disposed at a profit or at a loss. But most of those minor workings will be at the level of the operating activity. So please, here, I hope as far as the investing activities and the financing activities are concerned, you know where to look at. Movement in non-current assets, investing activities. Movement in the non-current liabilities and equity is financing activities. And you can see examples here. So, I'm going to end this video at this level, and I'm going to make a new video where I'll be explaining the direct method of the operating activity, and I'll also make another video where I explain the indirect method. I don't want to make long videos, so I'll make short videos. So on those videos, I'm going to solve. So I did this because when I solve, I should be able to solve through. So if you find this video useful, please do not forget to share it. Those studying accounting, right, whether at the university, doing professional programs like the ACCA, the CPA, right, please share this video. I greet all of you people from Kenya, from Tanzania, from Ghana, from Nigeria. Please, you are highly welcome. Please subscribe to the channel and share the video. Thank you very much. It has been a pleasure serving you. Until next time, remember.